thinking that every day when I drive my daughter to school, it's like in a movie. It's like California at its best. You have the palm trees, you have the torrey pines, you get the cliffs, you get the beaches, you get the bungalows. You have a city. People are very relaxed. Tons of surfers in the morning, very early in the water, in the ocean. It's very nice.
It's a really blessed part of the world.
Welcome to Roll Right In, the podcast where we delve into the pressing economic and financial issues of our time with Max from Oceanic Partners, a VC firm from San Francisco. I'm your host, Fabian, Studio Alpha, an accelerator for software startups. How are you, Max? Everything's okay?
Doing all right. See, you're back in San Diego. It was good having you here last week. Good little sit down. I think I'm still a little hungover.
Yeah.
Still digesting.
That was fun.
Still digesting the barbecue. It was a good
Exactly.
time.
And I'm getting back used to the warmer temperatures. It's again in San Francisco. I have to mention that probably that was one of the most windy week I have ever seen in San Francisco. That was just crazy. I posted a picture on Golden Gate. That was just like, I don't know, 8.4 or something like that. It was crazy.
Yeah, I suppose global warming is happening, but it's not here. They're just taking whatever warmth we had and moving it elsewhere, whoever they are in this case.
Yeah, but San Diego is just like very nice.
San Diego has some of the world's most perfect weather.
Yeah, so at the financial markets, it's also a very privileged situation. It's not getting boring. In today's episode, we're turning our attention to Capitol Hill, where the word debt ceiling are reverberating through the hallway of Congress and the newsroom across the nation. So people also asking me, since there's Fitch, one of the top 3 credit rating agencies, has placed this US AAA credit rating on a rating watch negative, signaling that it could downgrade US debt if lawmakers do not agree on a bill that raises US Treasury's debt limit. So let's talk about this now. It becomes more dominant in the media. Let's start. What is the debt ceiling and what is going on with it? Max?
Yeah, so in the context of kind of range-bound markets that on the surface have recovered somewhat, again driven a lot by the tech majors, this has been really the one news item that has kind of drawn a lot of attention, a lot of the kind of dominated the headline space. So it's a fairly simple and kind of artificial issue of our own making. The US just has basically a statutory debt limit, and we've had one since 1917. So it's just a congressionally set limit to how much federal public debt can be outstanding at any given time. So the cumulative amount of total debt. And so this is not the same as the deficit that the US can run in any particular year. It's not directly related to that kind of deficit budget consideration. It just relates to, again, the size of the outstanding debt. And it's been raised obviously many, many times since 1917. It's been raised, the stat is 78 times since 1960. And normally this is a fairly procedural negotiation within Congress. We reach the debt ceiling, we raise it because we always do and we have to. It's just we've gotten to the sort of political environment where the debt ceiling is more routinely used as kind of a negotiating tactic. And so there's a very high level of political polarization in the United States. The two parties want very divergent things. There's been kind of realignment under the hood of parties of what major interests support what parties. And that's creating a bit of disarray, and it's driving the parties kind of farther apart. And it's encouraging this sort of brinksmanship on the part of the parties to basically get concessions. And right now, at this point, they're debating. Essentially, the subject of contention is discretionary spending. So the Democrats and the Biden administration, they want to raise the debt ceiling with no real with no connection to any sort of budget cuts. I mean, they just want to raise it without making any sort of concessions effectively. And the Republicans, they want some cuts in discretionary spending. So we're not talking about mandatory spending like Medicare and Social Security, just really the relatively minor slice of discretionary spending, and just basically slowing down the growth of that discretionary spending over time. So it's not really even a substantial level of cuts. But nevertheless, there's just been this back and forth, and it's just high drama. It seems like it's been happening more and more with successive years, which kind of evidences the overall tenor of the political environment. But the current limit, it's at 31.4 trillion, and we've basically breached it in January.
Okay, so basically, this topic comes up on a regular basis. The stock exchanges are tremendously more nervous than normal. Is that something that happens like in every situation after midterms when the president loses majority?
So kind of a few things there. So the debt ceiling, it's a little bit of a different negotiation from a kind of like a budget reconciliation. So coming up with the budget for the next year, that has been coming up in the prior years. Actually, having these prolonged and very acute battles over the debt ceiling happens a little bit more rarely. Since 2013, the debt limit has been suspended multiple times just to kind of avoid the issue. But what we've seen in prior years, so we've had, a 2018 government shutdown, a federal government shutdown, that was not directly related to the debt ceiling. That was more related to the inability to generate a budget that both parties agreed to. As to why, the president and, a Congress that's unified behind him wouldn't just do this when the president gets elected and has that political capital. I'm not a politics expert, but I would just assume that political capital is best spent elsewhere. This debt ceiling is kind of it's sort of theater, right? And we know that it always gets raised. So if you have, if you have majority, if you have to have majority in both, in both chambers of Congress, and you have, administration, everyone's on board, they have other places where they can spend that political capital. It's not really, the debt ceiling is not really their hill to die on. And it's always a contentious issue because it does touch on spending and kind of different priorities between the parties. And maybe that's just not the conversation that they want to have.
But why is it happening right now? Why is it happening right now?
Well, the Treasury.
Is it a war? Is there a particular incident that forced the president to raise the budget the way that he exceeds the limit of this debt ceiling because of Ukraine war or because of post-COVID issues?
Yeah, COVID has something to do with it. As we've covered in prior episodes, we've accumulated a lot of debt during COVID, and this is to fund, the unprecedented fiscal stimulus that we undertook during the pandemic. And all of this happened in a very, very low interest rate environment that was artificially low. It was just managed to the zero bound by the Fed and all the central banks globally. And so that debt was accumulated at very, very low interest rates. And now interest rates are much higher. So you're starting to basically auction debt at higher rates, and that is starting to basically bite into the budget. It's not a huge issue yet, but it's starting to put kind of strain on, basically public finances. And so, the cost of debt service versus GDP is rising. I mean, the Treasury has certainly been aware of this issue for a while. They've been talking about the debt ceiling, that this is going to be an issue since basically mid last year. Since January, because we are technically in breach of the debt ceiling, we've reached it. The Treasury's been undertaking these quote unquote extraordinary measures. So basically, they've been cutting back certain contributions to certain programs. I mean, there's just a variety of little adjustments that they can make to the budget in extraordinary to payments in extraordinary circumstances. But we're kind of reaching that point where they've exhausted their ability to sort of extend, right? These extraordinary measures, we're kind of reaching the bottom of the barrel there. And so in the beginning of June, potentially as soon as June 1st, we're at that point where the Treasury general account simply runs out of free capital, and we cannot raise more debt to basically service our operational and financial obligations. So, interest and principal on maturing debt may not get paid off. And so that would constitute basically a technical default.
Why are we really only hearing about it now? Did you now talk about this? Is that correct?
Yeah, I mean, because we always raise the debt ceiling, we never assume that it's a very serious issue until we come up right against the deadline. Again, over the last couple of decades, we've seen several instances of Congress failing to basically reach consensus on the debt limit. And, it's been suspended by Congress about 7 times since 2013. This forced a brief government shutdown in 2013, so it's not unprecedented.
Yeah, so we know that this has happened before several times. And like each time, like right now, the closer we get to the deadline in the media, it's, on a daily basis, it becomes more drama.
Yeah, it has indeed happened before several times. Several instances of Congress failing to reach consensus about the debt limit. I mean, the debt limit itself has been suspended by Congress. It's happened 7 times since 2013. This debate over the debt ceiling, it forced a US federal government shutdown in 2013, which lasted, I think, about a week. And the last time that this was probably as serious as this was in 2011. And the deal was struck just a few days before the Treasury would run out of money. So it's a pretty similar
Obama,
circumstance. Right? That was during Obama, yeah.
Obama.
So it's a fairly similar circumstance to where we are now, where we're really just up against the wire in these negotiations. At that point, there was a brief but kind of meaningful period of market turmoil, and we actually got our debt downgraded by the S&P.
And what happened then?
It does happen, and it has happened, and it's been, and it's been this headline grabbing thing, going back to 2011, at the very least, at least on this scale.
But what are the real prospects here? I mean, what happened at the stock market? Was it bad? Did we have a crash? Or keep people cool? Keep them going cool, or?
There was increased volatility. I mean, you would kind of expect that bonds would sell off because there's less confidence in the government and the dollar, and that's not exactly what happened. I mean, and I don't remember exactly, but I think certain kind of longer term maturities they rallied because the dollar and longer term government bonds are still very much a safe haven for the world. I mean, no one, I think, seriously expects the United States to default totally and completely on the entire, cumulative pile of government debt. There might be a, technical default. We might miss a coupon. It might get paid a little bit late. But, I think the realistic prospect is that, going by history, this is going to get raised. I mean, I don't think any amount of political brinksmanship is really worth the consequences of default, and especially a prolonged default. I mean, a prolonged default would be absolutely disastrous just because of how important, how ubiquitous, the US dollar is in basically any, I mean, in the global financial system, in trade, the dollar and U.S. government debt are just kind of integral for the global economy to function. So, real meaningful default would be disastrous. Then, yeah, I mean, I would expect a very steep sell-off in stocks and probably, some massive intervention by the central banks.
But
But
how
this,
realistic is it? I mean, people like to talk about all these worst case scenarios, but the question is always what is the what is the probability that happens?
I mean, it's still fairly low. No one really truly expects it to happen. And if it does happen, if something does happen, it will probably happen within this very short span of time. So, we've seen some bond market turmoil already at the very short end of the yield curve. Some of the T-bill maturities that mature, around the 1st of June, kind of the 7th of June, which is about where the X date would be. The yields there have spiked over 7%. So it's much, much higher than the Fed funds rate. I mean, the very short-term maturities is exactly where the Fed can sort of set rates, and the Fed funds rate, is at 5 and change, and it's at 7%. So it is kind of reflecting some loss of confidence that at least there's going to be a timely payment on that specific maturity, and it's not really doing much at the further end of the curve. So it's not a default for 2 years and 5 years and 10 years and 30 years. I mean, it's just this one specific maturity over this specific span of time. It is creating some impact. So like this slide here, it's the CDS on this the US 1 year, the 1 year CDS. So it has spiked meaningfully, but I don't think this corresponds to very high probability of default yet. I mean, it's just kind of demonstrating that it's more than zero. There's some meaningful move there, but it's still fairly well contained. And again, going by history, we've always reach that deal, and it's always there's always concessions made, and the negotiation ultimately works out. But if there's an actual default, if that's just the path we're going to go down, it's going to be fairly chaotic. Interest rates could go either way. I mean, differently across the yield curve, perhaps more inversion, I would guess. There would be financial system ramifications, trade ramifications, loss of confidence in the dollar as a reserve asset, potentially. I mean, those are not scenarios that are kind of easy to model, or we probably should be modeling or spend a lot of time modeling, because it just does seem rather unlikely. Most likely, the debt ceiling just gets raised. The Treasury begins to issue more bonds, finance its budget commitments that exist already. That would actually have the interesting effect of drawing liquidity out of the system, because when the Treasury issues bonds, it's basically soaking up money out of the broader economy that's been bouncing around, and it's locking that money up in bonds that it then spends over time for budget commitments. So together with QT and what the Fed is doing, that actually has some additional incremental effect for draining liquidity out of the financial system. So we'll just have to see what the impact of that would be.
Okay, so Ray Dalio said, look, either way is not good. So if the debt ceiling gets raised, then we're just piling debt on existing debt, which is not good. If you would not raise the ceiling, then money is missing to support the social projects. You have to redo the budget, and that will harm also many people from the social aspect. What do you think?
Yeah, well, we are talking about a fairly kind of minor part of the budget. I mean, it's a significant part of the budget, but it's not, it's not Social Security, it's not Medicare. Those are non-discretionary items. So I think those get cut, last. There's a lot there's a lot of reasons to believe that, the Social Security Trust Fund and, the Medicare, kind of the Medicare funding is, there are some stresses that will play out over the years. The Social Security specifically, just it's very much demographically driven. We're not to that point yet. The debt ceiling is just really more of a tactical, more of a short-term consideration. And debt debt grows in this kind of economy, right? We live in a sort of modern monetary theory sort of monetary system where debt naturally grows.
That's not a bad thing. This is just a bad thing. It's not. It depends.
It's a natural thing, I think, for an economy that controls its own currency supply, and the currency is not backed by anything, by any sort of hard asset like it used to be backed by gold. So, I mean, any deficit that the public sector runs is basically a surplus for the private sector and its money supply, effectively, right? So, I mean, the growth of debt, it sort of mirrors the growth of money supply. It creates this collateral class in the economy via government bonds. So no one is, this huge pile of debt, 31 trillion is never going to get fully paid back. It's not intended to get paid back. It's not the function of debt in a modern economy. I mean, it's a way for creating money supply effectively.
Okay. But somehow this has to be financed. Now it's financed by these treasury bonds. And these treasury bonds become longer and longer. So we know the T-bills, we know like 2 year, 5 year, 10 year, there are 20, 25 years when I'm right. So, is this also, is that something that's also normal, that we will see 50, 75-year bonds, treasury bonds soon?
It could be. I mean, I think there was some chatter about going with a 100-year bond when we were at basically 0% interest. When you're at 5%
Exactly.
interest, it makes a little less sense to do that. But yeah, I mean, it's possible that we extend out to very far maturities. We haven't really done that yet. I suppose if we get back to really low interest rates, that might be something that we would consider. But again, you can't shift your entire debt load into these very, very far maturities. I mean, you need certain very short maturity instruments for the financial system to kind of have collateral and to function. So I mean, there is a financial system consideration for the kinds of maturities that you release. And you try to have your debt kind of match your liabilities as well.
Okay, so from another perspective, it's like a company. You also can make debt, or you get investors, you have cash at hand. And now it's strategically important how you are going to invest this money. If you invest in something that does not generate additional value in the future, then you will lose. So it's a must also for a country, if they have a deficit or a debt, that this money is invested in things that creates value in the future, right?
Yeah. I mean, I suppose there's a bit of a political debate as to what constitutes
is value. What is value?
The best kind of spending, right? Long term. You would imagine that education is an investment that you have to make. Technological basic research, advanced research. Those are all kind of investments you make. They're fairly small parts of the budget. Again, you can do when you're operating at at the kinds of deficits, the kind of budget levels that we have. You can do a lot of scientific research, right? It's mostly there to service our social commitments and entitlement programs and a vast military, right? So those are the three big components of the budget. It's Social Security, it's Medicare, and it's the military. And we need the military to kind of project power globally and to maintain the dollar as a global reserve currency. which is the one big factor. It's, or at least it's a big pillar of what makes the dollar can sustain its value despite the fact that we can print it. That the central bank is always there. The world needs the dollar, and it will need the dollar for the foreseeable future. The dollar is our primary export, and it's basically what keeps the entire financial system and the entire trade system globally running smoothly.
Yeah, by the way, it's not the case that the United States is the only country that has to raise debt ceilings. Everybody's again just, focusing the United States at the moment. And it looks like, that other countries who have this issue too, they're kind of, they get forgotten. They have been forgotten.
It's true. And there are countries with a higher debt load to GDP. Japan is the notable example. And Japan, and again, it really depends on your kind of positioning in the global economy and the specifics of your economy. Japan has a rapidly aging population of savers, right? And they don't have a lot of demand for consumption. They don't have a lot of demand for equities. I mean, this has been the case for the 3 lost decades, right? Post the Japanese bubble collapse, right? And so they're prolific savers, and that saving goes into, basically essentially a government-run savings fund, right? That's run by the Japanese Post, if I recall correctly. And that gets invested in Japanese government bonds. And on top of that, Japan pioneered the whole notion of quantitative easing. So they've been essentially printing money for a very long time. But this has not caused inflation. It's not caused a lot of economic growth either. Their inflation has picked up recently and meaningfully, which, I mean, they've been trying to achieve, some level of natural inflation in the economy. And I'm not sure this is the kind of inflation that they necessarily want. And it might, it might be a significant budget issue for them in the future, where they both want inflation, but they also need to keep their interest rates low, because the interest and the interest load on all that public debt becomes untenable after a certain point, which may be the case here in the United States, right? So we'll raise this debt limit, but we're kind of running into the limits of mathematics, where if we go on at 4 or 5% interest rates for a long time, for 10 years, call it, that will be the cost of servicing debt in the United States, and it's a very large pile of debt that will consume a bigger and bigger part of the budget. So at a certain point, you have to make some decisions as to what you do, right? You could run inflation. If you're a central bank, you can run inflation at a higher rate than your rate of interest. So you're basically devaluing the currency. So this is why inflation is kind of a natural consequence and a desired component of a modern economy like this, because you get to just deflate away, or you get to you devalue your debt over time. So that might be, a consideration for just having higher natural rates of inflation in the economy, right? And you would intuitively expect that to happen when you print money, when you increase debt at a higher level than GDP, when eventually there is going to be some kind of a currency debasement effect. Or you could, take the take the responsible route eventually. I mean, just decrease spending, but potentially increase taxes. Try to balance the budget, and just have that natural rate of inflation erode away at that debt for for a while. But those are hard decisions to make. And for now, we're just going to raise the debt ceiling, or we're going to push this issue out into the future.
Okay. After all, what does that mean for the startups? What does that mean for the private financial markets? Nothing. We don't really care, do we?
The private markets are very insulated from. I mean, this is short-term market dynamics. I mean, clearly we see some spikes in very short-term rates. The yield curve is doing some weird stuff. the equity markets might feel a little bit more unsettled. But given that this is, or it seems to be, political theater for the most part, it's unlikely that there will be a strong direct effect. Any prolonged market turmoil would likely be a negative thing unless it prompts, very sudden reversal of tightening from the Fed, in which case, certain risk assets might benefit just kind of on a knee-jerk basis. I mean, you might have some market participants at the margins making decisions just out of a general concern for what the debt ceiling issue might mean long term. But again, that would happen at the margin. Longer term, it does portend some difficult decisions that you have to make. I mean, especially in light of higher interest rates, higher debt service costs versus GDP. And you have to do all this in a divided and polarized political environment. So these issues will come up again. They will likely be solved again, but just as a general commentary on the status of our political system and our society, it's probably not the best thing that we just can't reach consensus even when we absolutely have to, and we have for decades previously.
But in a nutshell, as a founder, you better concentrate on your startup and don't read the newspaper about the debt ceiling. The debt ceiling is not something that you should lose time on.
Yeah, I would say it's not the kind of issue that directly affects the startup founder in the short term.
Okay.
So it's the piece of news that is good to be aware of. It's clearly good theater, but they need to focus on running their business and trying to get funded and all the classic founder stuff.
Exactly. So yeah, thank you very much, Max. I hope that was helpful. Please leave comments if you have questions, or just tell us what you think about that. And don't forget to ring the bell and subscribe to our channel. That will make us happy. See you next week. Thanks.
Till next week. Thanks, Fabian.